Have you ever wondered how mortgage rates are determined, but felt it was too complex to wrap your head around? Well, we're here to help, so let's dive right in. To start, let's begin with securitization. Securitization is when several mortgages are gathered and bunched together into a single pool of mortgage loans. The new pool of loans is then broken down into mortgage bonds. Each of them are then categorized at their own risk level. A AAA rating is the lowest risk, while unrated or junk bonds are the highest risk. After being rated, they become known as mortgage-backed securities. These mortgage-backed securities are traded on a daily basis, making them somewhat volatile. Now, let's get into how those rates are decided. Mortgage bond prices and the rates attached to them move like a seesaw. So if the rate goes down, the price goes up. To see what's happening with the fluctuation of rates, we can use a candlestick chart. Candlestick charts are used to decipher the price movements with securities, derivatives, and currencies. But for ease, keep in mind that green is good, which means bond prices are going up and mortgage rates are going down. The key takeaway is that bond prices continually change and mortgage rates adjust from there. Many people claim that the 10-year treasury is what we should watch to see where rates will be headed in the future. However, that might not be wise because there is a difference between mortgage-backed securities and the 10-year. The three major differences are 1. The time and maturity, 2. The level of risk, and 3. The overall correlation between them both. For starters, when one goes up, the other, more often than not, will go down. Remember the seesaw pattern we talked about earlier. With that being said, loan officers should focus on mortgage-backed securities, but still continue to monitor the 10-year treasury as well as the overall economy. This is important to keep in mind because mortgage-backed securities are competing for the same investment dollars. Remember, the overall economy, which includes inflation and even the price of oil, all have an effect on the prices of mortgage bonds, and therefore mortgage rates. And for those of you trying to figure out mortgage rates on your own, since everything is so volatile on a daily or even hourly basis, please remember to avoid the news media at all costs. The client themselves are also integral in deciding the interest rate. Their credit score, loan type, loan amount, and term all play a role in determining what their interest rate will be. So if you're serious about getting a loan, we can help you navigate these variables, lock your rate, and successfully close your loan.